I need to have a serious conversation with you about something that is quietly destroying the retirement savings of millions of Americans. And what makes this particularly dangerous is that the people losing money think they are being smart. They think they are being sophisticated. They have been told by financial advisors, by the media, by so-called experts that what they are doing is the responsible thing. I am talking about certain exchange-traded funds that have become wildly popular over the past few years. ETFs that people are pouring billions of dollars into every single month. ETFs that seem safe on the surface but contain hidden dangers that most investors do not understand. And by the time they figure it out, by the time they realize what has happened to their money, it is often too late. Now, let me be clear about something from the start. I am a huge believer in index funds. I have said many times that for most investors, the best thing you can do is put your money into a low-cost S&P 500 index fund and leave it alone for decades. That advice has not changed. The broad market index fund remains one of the greatest wealth-building tools ever created for ordinary people. But not all ETFs are created equal. Not all ETFs are simple index funds. The ETF industry has exploded in recent years, and Wall Street, being Wall Street, has created all sorts of complicated, expensive, and downright dangerous products and slapped the ETF label on them. These products are marketed to make you feel sophisticated, to make you feel like you are getting access to advanced strategies that were previously available only to the wealthy. But what you are actually getting, in many cases, is a product designed to extract fees from your pocket while exposing you to risks you do not understand. You are getting complexity dressed up as sophistication. You are getting Wall Street's latest invention for separating investors from their money. Today, I am going to tell you about 4 specific types of ETFs that I believe you should avoid. These are not obscure products. These are some of the most popular ETFs in America with hundreds of billions of dollars in assets. Your retirement account probably owns at least one of them right now. And after you hear what I have to say, you may want to reconsider that ownership. The first type of ETF you need to get out of is leveraged ETFs. These are funds with names that include terms like 2 times, 3 times, ultra, or double. They promise to deliver 2 or 3 times the daily return of some underlying index. If the S&P 500 goes up 1% today, a 2 times leveraged S&P 500 ETF promises to go up 2%. Sounds great, right? Double the return for the same investment. Here is what the marketing materials do not tell you. These products are mathematically designed to lose money over time, even if the underlying index goes up. This is not opinion. This is not speculation. This is mathematical certainty built into the very structure of how these products work. Let me explain why. Leveraged ETFs reset their leverage daily. Every single day, they rebalance to maintain that 2 times or 3 times exposure. This daily reset creates something called volatility decay or beta slippage. In plain English, it means that the compounding of daily returns does not equal the compounding of the underlying index returns over longer periods. Let me give you a simple example that illustrates this perfectly. Imagine an index starts at 100 on day 1. It goes up 10% to 110. On day 2, it goes down 10%. Now 10% of 110 is 11. So the index falls to 99 after 2 days. The index is down 1%. Now let us see what happens to a 2 times leveraged ETF tracking this same index. On day 1, the index goes up 10%. So the ETF goes up 20%. If it started at 100, it is now at 120. On day 2, the index goes down 10%. So the ETF goes down 20%. 20% of 120 is 24. So the ETF falls to 96. Do you see what happened? The index is down 1%. The leveraged ETF is down 4%, not 2%, which is what you might expect from 2 times leverage, 4%. The daily reset mechanism destroyed value, and this happens every single day. Every time the market moves up and then down or down and then up, the leveraged ETF loses ground relative to what simple leverage would suggest in volatile markets, which is most markets most of the time. This decay can be devastating. I have seen people hold 3 times leveraged ETFs for months or even years, expecting to get 3 times the return of the market. Instead, they lost money even when the market went up. They could not understand what happened. They thought the fund was broken or that someone was cheating them, but nobody was cheating them. The mathematics were working exactly as designed. The product did precisely what it was supposed to do. It just was not what the investor thought it was supposed to do. These leveraged ETFs are designed for day traders. For people who are making bets on what the market will do in the next few hours, they are absolutely not designed for long-term investors. They are not designed for retirement accounts. They are not designed for buy and hold strategies, and yet millions of ordinary investors own them because the marketing makes them sound attractive. If you own any leveraged ETF in your retirement account, I would strongly encourage you to sell it immediately. I do not care if you have gains or losses. I do not care what you paid for it. These products will destroy your wealth over time with mathematical certainty. Get out now before the decay consumes more of your savings. Let me share a real example I have observed. I know an investor who bought a 3 times leveraged NASDAQ ETF in early 2020. He was convinced that technology stocks were going to keep rising. And you know what? He was right about the direction. The NASDAQ did go up substantially over the next couple of years, but this investor held his leveraged ETF through all the volatility. He held it through the drops and the rebounds. He held it through the chop and the sideways movement. And because of the volatility decay I described, his 3 times leveraged ETF dramatically underperformed what 3 times the NASDAQ return would have been. In fact, during certain volatile periods, the NASDAQ went up and his 3 times leveraged ETF actually went down. He could not understand how this was possible. He accused his broker of fraud. He thought the ETF was broken, but nothing was broken. The mathematics were working exactly as designed. He simply did not understand what he had bought. There is another problem with leveraged ETFs that most people do not consider. The fees are much higher than simple index funds. A typical leveraged ETF might charge 1% annually compared to 3 basis points for a simple S&P 500 fund. Over decades, that fee differential alone destroys enormous amounts of wealth, even before you account for the volatility decay. The financial industry loves leveraged ETFs because they generate substantial fees and encourage frequent trading. Every time you buy or sell, someone collects a commission or a spread. Every day you hold, someone collects management fees. The product is designed to make money for Wall Street, not for you. The second type of ETF you need to avoid is inverse ETFs. These are funds designed to go up when the market goes down. They are marketed as hedging tools, as ways to protect your portfolio from market declines. An inverse S&P 500 ETF promises to go up 1% when the S&P 500 goes down 1%. On the surface, this sounds like great insurance. If you are worried about a market crash, why not buy some inverse ETFs to protect yourself? If the market drops 50%, your inverse ETF should double, right? That would offset your losses in your other holdings. Here is the problem. Inverse ETFs suffer from the exact same volatility decay as leveraged ETFs. They also reset daily. And that daily reset means they do not actually track the inverse of the index over any period longer than 1 day. Let me show you with another example. Imagine the S&P 500 starts at 100, it drops 10% to 90, then it rises 11.1% back to 100. The index is flat, you lost nothing. If you own the index now, look at what happens to an inverse ETF. When the index drops 10%, the inverse ETF rises 10% from 100 to 110. When the index then rises 11.1%, the inverse ETF falls 11.1%. 11.1% of 110 is about 12.2. So the inverse ETF falls to about 97.8. The index is flat. The inverse ETF lost 2.2%. You tried to hedge and instead you just lost money on the hedge. This is not a bug. This is how these products work by design. But it gets worse. Markets tend to go up over time. That is the whole reason we invest in stocks, because over long periods they rise. So if you hold an inverse ETF for an extended period, you are betting against the long-term trend of human progress and economic growth, even if you think a crash is coming. Timing that crash precisely is nearly impossible. And while you wait for your predicted crash, the inverse ETF is bleeding value every single day. I have watched investors lose 50, 60, 70% of their money in inverse ETFs during bull markets. They were convinced a crash was coming. They were certain the market was overvalued. Maybe they were right about the eventual direction. But being early is the same as being wrong when you are holding a product that decays daily. Professional traders use inverse ETFs for very short-term tactical positions measured in hours or days. They understand the decay and account for it in their strategies. But ordinary investors, people saving for retirement, have no business owning these products. They are not hedges. They are not insurance. They are slow motion wealth destruction disguised as protection. If you own inverse ETFs because you are worried about a market crash, sell them if you want to protect your portfolio from declines. There are better ways to do it. Hold some cash, own some bonds, diversify into assets that do not correlate with stocks, but do not try to hedge with a product that is designed to lose money over time. I want to tell you about something I witnessed during the 2008 financial crisis. There were investors who correctly predicted the crash. They bought inverse ETFs in 2007, convinced that the market was about to collapse. And they were right. The market did collapse spectacularly in 2008. But many of these investors did not make money. Why? Because they were early. They bought their inverse ETFs in 2007. And the market kept going up for a while before it crashed during that period. Their inverse ETFs bled value every single day. By the time the crash actually came, some of them had already lost so much to volatility decay that even the crash did not make them whole. Being right about direction is not enough. You also have to be right about timing. And with inverse ETFs, you have to be right about timing with extreme precision, because the decay starts immediately. Every day you hold, you are losing a little bit of value. If the crash does not come quickly, you can lose more waiting for it than you make when it finally arrives. I have also seen investors use inverse ETFs as permanent hedges, keeping them in their portfolio at all times as insurance against market declines. This is financial malpractice. It is like paying for fire insurance that costs more than your house every few years. The insurance is more expensive than the thing you are trying to protect. The correct way to protect against market declines is to own a properly diversified portfolio in the first place. Own some bonds, own some cash, own some international stocks. Do not put 100% of your money into aggressive investments and then try to hedge with a product designed to lose money. That is fighting the last war with the wrong weapons. The third type of ETF I want to warn you about is complex strategy ETFs. These are funds that implement sophisticated trading strategies, things like covered calls, put writing, volatility targeting, momentum rotation, or other quantitative approaches. They have names that sound impressive and scientific. They promise to generate income, reduce volatility, or enhance returns through strategies that were previously available only to hedge funds. Here is my concern with these products. They are black boxes. Most investors who own them have absolutely no idea what is happening inside. They do not understand the strategies being employed. They do not understand the risks. They do not understand when the strategy will work and when it will fail spectacularly. Let me give you a specific example. Covered call ETFs have become enormously popular in recent years. These funds own stocks and then sell call options against those stocks to generate income. The pitch is appealing. You get the upside of owning stocks plus extra income from the option premiums. Who would not want that? But here is what the marketing does not emphasize. When you sell a covered call, you are capping your upside. If the stock goes up significantly, you do not participate in those gains above the strike price of the call you sold. You get the premium, but you miss the big move. This means covered call strategies systematically underperform in strongly rising markets. And guess what kind of market we have had for most of the last 15 years? A strongly rising market. Investors who bought covered call ETFs thinking they were being conservative have significantly underperformed simple index funds, but it gets worse. In sharp market declines, covered call ETFs provide only minimal protection. The premium you collect from selling calls might be 1 or 2%. If the market drops 20%, you are still down 18%. The strategy does not protect you when you actually need protection. So what you end up with is a product that underperforms in up markets and still loses significantly in down markets. The only environment where covered call strategies shine is a flat, range-bound market with high volatility. That is a very specific condition that does not occur most of the time. I am not saying covered call strategies are inherently bad. Sophisticated investors who understand options can use them effectively. But buying a covered call ETF without understanding the trade-offs, without understanding when the strategy will work and when it will fail, is gambling, not investing. The same principle applies to all complex strategy. ETFs volatility targeting funds sound great until volatility spikes and they sell at the worst possible time. Momentum rotation funds sound great until momentum reverses and they are caught holding yesterday's winners. Every complex strategy has conditions where it works and conditions where it fails. If you do not understand those conditions intimately, you are taking risks you cannot quantify. My advice is simple. If you cannot explain exactly how an ETF works to a 10-year-old, you probably should not own it. If you cannot explain what market conditions will cause it to outperform and what conditions will cause it to underperform, you probably should not own it. Complexity in investing usually benefits the people selling the product, not the people buying it. Stick with simple, transparent, low-cost index funds. You do not need complexity to build wealth. You need patience, discipline, and costs low enough that compounding can work its magic. Every layer of complexity you add is another layer of potential problems, another layer of fees, another thing that can go wrong. I want to share another example that illustrates the danger of complex strategy ETFs. There is a category called volatility targeting funds. These funds promise to reduce your portfolio volatility by automatically adjusting their stock exposure based on market conditions. When volatility is low, they hold more stocks. When volatility spikes, they sell stocks and move to cash or bonds. This sounds reasonable in theory. Reduce exposure when things get dangerous. Increase exposure when things calm down. But in practice, these funds tend to sell stocks after they have already dropped and buy stocks after they have already recovered. They are systematically buying high and selling low. During the COVID crash of March 2020, volatility spiked to historic levels. These volatility targeting funds sold massive amounts of stock at the worst possible time, right at the bottom. Then as volatility declined over the following months, they slowly bought back in at higher prices. The result was that investors in these funds missed most of the recovery. A simple buy and hold investor who owned a basic index fund and did nothing would have been fully invested during the entire recovery. They would have participated in the entire bounce. But the sophisticated volatility targeting fund, the one designed by quantitative PhDs with fancy algorithms, sold at the bottom and bought back at the top. Complexity failed. Simplicity won. This is not an isolated example. It is a pattern I see repeated across all sorts of complex strategy ETFs. The strategy sounds good in theory. It might even backtest well on historical data. But in real time, in actual markets with actual motions and actual transaction costs, the complexity introduces problems that more than offset any theoretical benefits. There is also a selection bias problem with complex strategy ETFs. The ones you see on the market are the survivors. For every complex strategy ETF that still exists, there are dozens that were quietly liquidated after they failed. The fund companies do not advertise their failures. They just close the funds and hope everyone forgets. So when you look at the complex strategy ETFs available today, you are seeing a biased sample that makes these strategies look better than they actually are. The fourth type of ETF I want to warn you about might be the most controversial, because these are some of the most popular ETFs in America. I am talking about thematic ETFs, funds that focus on trendy investment themes like artificial intelligence, clean energy, cannabis, blockchain, robotics, space exploration, genomics, or whatever the hot topic of the moment happens to be. These ETFs are brilliantly marketed. They tap into your excitement about the future. They make you feel like you are investing in innovation, in progress, in technologies that will change the world. And you know what? Many of these themes are real. Artificial intelligence probably will transform the economy. Clean energy probably will grow dramatically. Some of these trends are legitimate. But here is the problem. By the time a trend is obvious enough to launch an ETF around it, by the time the marketing materials are printed and the fund is advertised on television, the easy money has usually already been made. You are buying after the excitement has driven prices up, often to irrational levels. Think about it from Wall Street's perspective. They do not launch thematic ETFs around boring, out of favor sectors. They launch them around whatever is hot right now, whatever has already gone up dramatically, whatever investors are already excited about. They are selling you what you want to buy, not what you should buy. The performance data on thematic ETFs is damning. Study after study has shown that the average thematic ETF significantly underperforms the broad market, not because the themes are wrong, but because investors pile in after the theme has already run up and then pile out after it has crashed. Let me give you a concrete example. Remember the clean energy boom of 2020 and early 2020. Lone clean energy ETFs were the hottest thing in the market. Everyone was convinced that electric vehicles and solar panels and wind turbines were the future, and they probably are the future. But investors who bought clean energy ETFs at the peak in early 2020, have lost 50, 60, even 70% of their money. The underlying trend was real. The technology was advancing. The policy support was genuine. But the prices people paid were so high that even a legitimate growth trend could not justify them. This is the problem with thematic investing. You are almost always buying at the worst possible time. The theme does not become popular until after the stocks have already risen. And by definition, if everyone already knows about a trend, if it is obvious enough to market an ETF around, then it is probably already priced into the stocks. I have spent 70 years looking for investments where I have an edge, where I know something the market does not appreciate. Thematic ETFs are the opposite of that. They are investments where you are guaranteed to not have an edge because you are buying whatever everyone else is already excited about. There is also a structural problem with many thematic ETFs. The theme might be real, but which companies will actually benefit? The clean energy theme was real. But dozens of clean energy companies have gone bankrupt. The artificial intelligence theme is real, but many AI companies will fail. Owning a basket of companies in a trendy sector does not protect you from picking the losers within that sector. And often the best way to profit from a trend is not to own the trendy companies directly. The best way to profit from the gold rush was not to mine for gold. It was to sell picks and shovels to the miners. The companies that will profit most from artificial intelligence might not be AI companies at all. They might be the companies that provide infrastructure, that own the data, that manufacture the chips. A thematic ETF probably does not own the right companies to actually profit from the theme. My advice on thematic ETFs is simple: avoid them. If you want exposure to technology, own a broad market index fund. The S&P 500 already has massive exposure to the largest, most successful technology companies. You do not need a separate AI ETF when you already own NVIDIA and Microsoft and Google through your index fund. If a theme is legitimate, if it is going to transform the economy, the winning companies will eventually become large enough to be significant positions in broad index funds anyway. You do not need to guess which themes will work. You do not need to time your entry perfectly. You just need to own the whole market and let the winners emerge naturally. Let me give you another example of thematic investing gone wrong. Remember the cannabis ETFs that launched a few years ago? Marijuana was being legalized in state after state. Canada legalized it nationwide. It seemed obvious that cannabis was going to be a huge growth industry. Investors poured billions into cannabis ETFs. What happened? The cannabis ETFs have lost 70, 80, even 90% of their value. The theme was real. Cannabis legalization did happen. The industry did grow, but the companies in those ETFs mostly failed. They burned through cash. They could not achieve profitability. Competition drove margins to zero. Being right about the trend did not translate into being right about which companies would profit from that trend. This is the fundamental problem with thematic investing. Identifying a trend is easy. Identifying which companies will profit from that trend is incredibly hard. And even if you identify the right companies, you have to buy at the right price. ETFs almost never accomplish all three of these tasks because they are launched after the trend is already obvious, when prices are already elevated. And they own a basket of companies chosen more for thematic relevance than for business quality. I think about my own investment in Apple. I did not buy Apple because smartphones were a hot theme. I bought Apple because I understood the business. I understood the ecosystem. I understood the customer loyalty. I understood the economics. I bought a specific company for specific reasons, not a basket of thematic stocks hoping some of them would work out. That is the difference between investing and speculation. Investing is buying specific businesses because you understand their competitive advantages and believe they are undervalued. Speculation is buying themes, hoping you pick the right one at the right time. Thematic ETFs are speculation dressed up as investing. Now let me step back and explain the common thread running through all four of these problematic ETF types. The common thread is that they all prioritize marketing over mathematics. They are all designed to be sold, not to be owned. Wall Street is in the business of selling products. They make money from fees, from transactions, from assets under management. They make more money when they can charge higher fees. And they can charge higher fees for products that seem sophisticated, that seem to offer something special, that seem to give you an edge. A simple S&P 500 index fund charges maybe 3 basis points in fees, 0.03%. There is almost no profit margin in that for Wall Street. But a leveraged ETF might charge 1%. A thematic ETF might charge 75 basis points. A complex strategy ETF might charge 60 basis points or more. The profit margins are dramatically higher. So Wall Street has every incentive to create and market these complex products. They have every incentive to make you believe that simple is not enough, that you need something more sophisticated, that ordinary index funds are for unsophisticated investors who do not know any better. But this is exactly backwards. The most sophisticated investors I know, the ones who have built real wealth over decades, almost all of them have remarkably simple portfolios. They own broad market index funds. They keep costs low. They do not chase trends. They do not try to be clever. They understand that in investing, complexity is usually the enemy of returns. There is a reason I have told my own wife to put 90% of her inheritance in a low-cost S&P 500 index fund. It is not because I could not design something more sophisticated. It is because I know that simplicity wins. I know that low costs compound. I know that trying to be clever usually backfires. Let me share some practical advice for evaluating any ETF before you invest. First, look at the expense ratio. If it is above 20 basis points, you should have a very good reason for owning it most of the time. You can find a cheaper alternative that accomplishes the same thing. Second, look at the structure. Does it use leverage? Does it reset daily? Is it designed for long-term ownership or short-term trading? If it is not explicitly designed for buy and hold investing, it probably should not be in your retirement account. Third, look at the strategy. Can you explain exactly how it works? Do you understand when it will outperform and when it will underperform? If not, you are taking risks you cannot quantify. Fourth, look at the holdings. Do you actually want to own these specific companies, or are you just buying the theme, the concept, the marketing pitch? If you would not buy the underlying stocks individually, why would you buy them bundled together in an ETF? Fifth, look at the track record, but look at it skeptically. Many ETFs are launched after a theme has already performed well. So their hypothetical back-tested performance looks great. But actual performance since inception often tells a different story. Look at how the ETF has performed since it was actually launched, not how it would have performed if it had existed earlier. Sixth, ask yourself why this ETF exists. Is it because there is genuine investor demand for this exposure, or is it because Wall Street saw an opportunity to launch a hot product and extract fees? Most ETFs exist because they can be sold, not because they should be owned. I want to address one objection I often hear. People say, but Warren, what if I want to invest in artificial intelligence? What if I believe in clean energy? What if I want exposure to these trends? Are you saying I should just ignore them? No, I am not saying that. What I am saying is that you probably already have exposure to these trends through a broad market index fund. The S&P 500 includes massive positions in the companies driving artificial intelligence. It includes companies benefiting from clean energy. It includes companies at the forefront of every major trend. When you buy a thematic ETF, you are making a bet that you can pick the winning theme, pick the winning time to invest, and pick a fund that owns the winning companies within that theme. That is 3 bets you have to get right. With a broad market index fund, you do not have to pick anything, you own everything. The winners will emerge and grow within your portfolio automatically. The track record of active stock picking is terrible. The track record of theme picking is even worse. The track record of timing is worst of all. Why would you try to do all 3 at once when you can just own the market and avoid all those decisions entirely? Let me close with a story that illustrates why simplicity matters so much in investing. I have a friend who is not a professional investor. He has a regular job. He has never read an annual report in his life. He does not watch financial television. He does not follow the markets. 25 years ago, he set up an automatic investment of $500 per month into a simple S&P 500 index fund. He has never changed it. He has never stopped it. He has never tried to time the market. He has never switched to a hotter fund. He just keeps putting in $500 every month, year after year, decade after decade. Today, that account is worth well over $1 million. He did nothing sophisticated. He did nothing clever. He just kept investing consistently in the simplest possible product and let compound interest do the work. Compare that to the countless investors I have met who chased leveraged ETFs, who bought inverse funds trying to time crashes, who piled into thematic ETFs at the peak of the hype cycle, who paid excessive fees for complex strategies they did not understand. Most of them have mediocre returns at best. Many have lost substantial money, and all of them have spent countless hours worrying, researching, trading, and stressing about their investments. My friend spent maybe 10 minutes setting up his automatic investment 25 years ago. He has $1 million and zero stress. The complex investors have far less money and far more anxiety. Who made the better choice? This is the fundamental truth about investing that Wall Street does not want you to understand. Simple beats complex almost every time. Low cost beats high cost almost every time. Patience beats activity almost every time. Boring beats exciting almost every time. The 4 types of ETFs I have warned you about today, leveraged ETFs, inverse ETFs, complex strategy ETFs, and thematic ETFs, they all violate these principles. They are complex when simple would work better. They are expensive when cheap alternatives exist. They encourage activity when patience would be more profitable. They are exciting when boring would build more wealth. If you own any of these products, I encourage you to take a hard look at why. Is it because you genuinely believe they will help you achieve your financial goals? Or is it because the marketing was compelling, because they made you feel sophisticated, because everyone else seemed to be buying them? There is no shame in simplifying your portfolio. There is no shame in admitting that a basic index fund is all you need. There's tremendous wisdom in recognizing that complexity usually works against you. I have spent 70 years in this business. I have seen every kind of product Wall Street can create, and I keep coming back to the same conclusion for most people. A simple, low-cost index fund held for decades is the path to wealth. Everything else is mostly noise, mostly marketing, mostly ways for Wall Street to extract fees from your pocket. Do not let them do it. Keep it simple. Keep costs low. Be patient. Let compound interest work. And stay away from the complicated, expensive, dangerous products that are designed to be sold rather than owned. Your future self will thank you.